Hello and welcome to Sectors Up Close. I'm Ludovica. Today we are talking oil prices with Viktor, Katona, head of oil analysis at Kper. The oil market has moved to a war footing. Brent has risen by $10 a barrel to over $75 a barrel over the past 3 weeks. And that's as Israel staged a series of debilitating attacks on Iranian-backed Hezbollah in Lebanon. Well, Tehran responded by firing a barrage of ballistic missiles directly at Israel on Tuesday. And Israel has vowed to respond, and investors are now concerned that it could target Iranian oil infrastructure, then prompting further internationalization of the conflict should Iran then up the ante by blocking the Strait of Hormuz or targeting Saudi Arabian infrastructure as it did in 2019. So how unstable is the oil market, and what impact will further escalation have on prices? Let's ask Kepler's Viktor Katona. Viktor, thank you very much for being with us today on the program. Well, first of all, what impact would an attack on Iranian facilities have on the supply?
Well, supply would definitely suffer. And Iran has been increasing its production effectively for the past 2-3 years, to the extent that right now it's one of the largest suppliers to China. 1/6 of China's imports is basically coming from Iran right now. And if that were to be jeopardized, the pricing impact would be immediate. 75 for Brent would no longer be the low case, but really should be, just a rebounding stage to 80, maybe 85. It could go to 90, depending on the extent of the strikes. So really, the upside it will be carried by the extent of the damage from that possible strike.
And exactly on this very point, I mean, could prices move higher should Iran then decide to shut the Strait of Hormuz? Because, as you said, it's very important, as we know, for global oil shipments. We've seen during the Red Sea crisis. What sort of impact would this have on prices?
Well, the shutting of the Strait of Hormuz would be the highest impact event that could potentially happen, right? Because the market is talking about who could potentially replace Iran, were Iran to be targeted. Well, the only answer to that is OPEC plus countries. But OPEC plus countries will not be able to export their crude if the Strait of Hormuz is closed. The only country that can move its crude away from the Gulf is Saudi Arabia. And even Saudi Arabia could do it to just a tiny margin of what it produces. So everyone would be shut in. Effectively, that means if the Strait of Hormuz is shut, you can count on triple-digit prices at least.
Triple digits, right. By one estimate, I mean, OPEC could easily make up for lost supply, having already cut production, right, by nearly 6 million barrels a day. Now, given that, why have prices moved the way they have, in your opinion?
Well, I think the geopolitical risk premium that we effectively had inbuilt for most of 2024 in oil prices has evaporated by September. September has seen an absolute demise of the risk premium in oil prices. People just lost faith in anything happening. Right now, it's back. It's front and center. It's back to such an extent that Libya is announcing that it's coming back, and no one cares. No one even listens to that story because everyone has suddenly become a geographer. Everyone is looking at Iran's map. I mean, everyone is looking at what could potentially be targeted. That's the high impact story right now.
Right, OPEC has only just met, but there's already a lot of speculation that OPEC will essentially restore supply anyways. What's your thinking around that?
Well, I think that the Israel-Iran conflagration that we see right now will not lead to a regional war, and at some point oil prices would drop back to 70. And I think after that, OPEC will be forced to postpone the return of its crude, and basically will just suffer as it has to. Because the big story that we have kind of forgotten in these very intense heated days, the big story of 2025 is oversupply. Everywhere you look, you just cannot avoid thinking about oversupply. It's front and large. And I think OPEC at some point, OPEC plus specifically, needs to acknowledge that. They need to realize that demand is growing slower than supply is. And then, what's the answer?
Right, and that's interesting that you mentioned oversupply, right? Because I want to say, at the start of the conflict, now the speculation actually, and some analysts are predicting that oil prices could go down to $60, even $50 a barrel next year because of that oversupply. What do you think?
Well, I think that because OPEC Plus ultimately will decide to maintain the current level of pricing rather than to risk, bringing it into a very negative, very bearish market, I think the normal range that we should be having in 25 should be 70 to 75. And then again, because the sentiment has never been this weak in the past 10 years, and everyone is just so heavily focused on China not growing basically at all in 2024, it could slump occasionally to a level where we think it's already dangerous. So I think the volatility that we see right now is kind of dangerous because it could lead to massive jumps that we see right now, but it could also lead to massive slumps, which could happen over the upcoming months.
That was very, very insightful, Viktor Katona from Kepler. Thank you very much for being with us today. And that is your look at oil prices. I'm Ludovica Brignola, and this is Reuters.